You know how it is. Your business is always changing, always evolving. But that lease you signed, that thing can feel like it's carved in stone. Or is it? Today, we're diving into what happens to your books when your business needs a change. And trust me, getting the accounting right isn't just about ticking boxes. It can be a real strategic advantage.
Look, business never stands still, right? You're growing, you're streamlining, you're pivoting to a whole new world. But your lease agreement, well, that's a fixed contract from the past. So the big question is, when your needs change, how do you make sure your lease, and maybe more importantly, your accounting for it, can actually keep up?
So, here's what we're going to do. First, we'll quickly cover what a lease modification actually is. Then, we'll jump into 3 real-world case studies. What to do when you need more space, what happens when you need less, and of course, what to do when things get complicated. And to wrap it all up, we'll build a simple playbook that'll help you handle any lease change with confidence. All right, let's dive right in with the fundamentals. We're going to be talking about Ind AS 116, which is pretty much the official rulebook for lease accounting here in India. So, according to these rules, what actually counts as a lease modification?
Okay, so what does that actually mean? Well, in simple terms, it's any official change to the deal that wasn't already in the original fine print. This could mean adding more office space, giving some back, changing the price you pay, or even fiddling with the lease term. If it's a formal amendment to that contract, boom, it's a modification.
So, let's get practical. We'll start with a scenario that, let's be honest, most businesses dream of. You're growing, things are going well, and you need more space. Let's break down exactly how the accounting works for that.
Okay, so here are the facts. You're 5 years into a 10-year lease for 2,000 square meters. Business is good, so you go back to the landlord and add another 3,000 square meters. Now, here's the crucial detail, the part you really have to pay attention to. The price for that new space is based on its current standalone market value.
And why does that one detail matter so much? Well, because the new space is priced fairly, at market value. The accounting rulebook sees it as a totally separate transaction. And this is great news, because it means the accounting is refreshingly simple. You just leave your original lease alone. Don't touch it. You just create a brand new separate lease for that additional space. It's like having 2 different deals running side by side. Easy enough, right?
Okay, so expanding at market rate is pretty straightforward. But what about the opposite? What happens when you need to downsize? Let's look at our second case, which you'll see is where things start to get a little more interesting. So, imagine this. You're halfway through a big lease for 5,000 square meters, but you realize it's just too much. So you renegotiate and you manage to cut your space in half, down to 2,500 square meters. And of course, your annual rent gets reduced to reflect that change. This slide lays out the before and after picture really clearly. You see the space goes down, the payment goes down. But the most important change I want you to notice here is the discount rate. It's changed. You have to use a new rate from the date of the modification. And why is that? Because the world has changed. Interest rates aren't the same as they were 5 years ago, and your accounting needs to reflect today's economic reality, not yesterday's.
Now this is a whole different ball game from our first case. You can't just leave the old accounting alone. Here you have to go back and remeasure your lease liability using the new payments and that new discount rate. You also adjust the value of your asset. And whatever the difference is, well, that hits your profit and loss statement right away as either a gain or a loss. It directly shows the financial impact of that decision to downsize.
All right, so we've seen a simple increase and we've seen a simple decrease. But what if it's not so simple? Let's tackle our final and, most complex case, a modification that's a mix of a few different things.
Okay, picture this. You're adding 1,500 square meters of new space. So far, that sounds just like case one, right? But, wait for it, here's the twist. As part of that same deal, the landlord agrees to reduce the rent you were already paying on your original space. Ah, now things are getting interesting.
So as you can see, you end up with more space, and yeah, your total payment has gone up. But if you do the math, it's pretty clear the price for that extra space is below what you'd get on the open market. Why? Because the landlord gave you a deal, tying it all together. The two parts of the lease, the old space and the new, are now financially linked. So remember in our first case, that market rate price was our ticket to creating a simple separate lease? Well, because the price here wasn't a standalone market rate, you absolutely cannot treat this as a separate lease. The old deal and the new deal are now basically one big new deal. And that means you have to go back and remeasure your entire lease liability using a new discount rate to reflect this new combined reality.
Okay, wow. We just walked through three very different situations. So let's zoom out for a second and put this all together into a simple playbook you can use for pretty much any lease modification that comes your way.
Here it is. Step one is the big one. It's the critical question you have to ask first. Is this a simple expansion at a fair market price? If the answer is yes, great. Treat it as a separate lease and you're done. But if the answer is no, for any other change, like downsizing or one of those mixed deals, you just follow the rest of the steps. You figure out the new terms, you apply a new discount rate from that day forward, you remeasure your liability, and finally, you adjust the asset on your books. So after all that, you might be wondering, why all these complex rules? It's actually pretty simple. Your business doesn't stand still, so your accounting shouldn't either. The whole goal here is to make sure your financial statements give an accurate picture of your business today, reflecting your current obligations and assets, not the ones you had years ago when you first signed that piece of paper. And I'll leave you with this to think about. Knowing what you know now, that a simple market-priced expansion has much, much simpler accounting than a complex renegotiation, how might that change the way you approach your next conversation with a landlord? It just goes to show you, understanding the accounting doesn't just keep you compliant, it can actually give you a real strategic edge at the negotiating table.